Hey everyone, welcome back for another dividend investing video. If this is your first time here, we are all about dividend growth investing as a means to create a stream of passive income that grows every year that can be used to supplement your retirement and pay your bills. I have multiple accounts that I'm using for this very purpose, and one of my favorite ways to do dividend investing is in a Roth IRA. For American investors, this lets us set post-tax money aside to invest, and any dividends or capital gains in this account are entirely yours. You'll not get a tax bill from Uncle Sam for the dividends you bring into this account. In this video, I'm going to show you how I've been investing in my own Roth IRA. I've been making a series of videos about this in 2023. And here is our mid-year update of the stocks I've been buying and how I'm on track to max out this account. So let's get into it. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. My current Roth IRA is held at Charles Schwab. I've held it for a couple years now. For 2023, I created a plan on how I was going to max this out and how I wanted to invest this money. We're limited to what we can add to this account. For those of us under 50, that's $6,500 annually. If you're over 50, you can add an extra $1,000 catch-up contribution for a total of $7,500. And I do this because, well, a lot of us didn't start thinking about these sort of things as early as we ought to have, and this is one reason I'm making this series, hoping I can reach folks in your 20s, in your 30s. These are prime years to get yourself invested. Time in the market beats timing the market. Get your money working for you. It does take time for a compounding magic to do its thing. Really, there's no better time than the present, even if you're in your 40s, your 50s, your 60s, or older, and you've never set anything aside for retirement, then get started right now. No better time than the present, and we are here to help. I make maxing out my Roth IRA a top priority, extremely high. Comes before I put anything in my taxable accounts. It comes before I take any kind of vacations. Just about anything that isn't a necessity. And in fact, I view investing in the Roth as a necessity. And with this Roth, I have three objectives. The first is to max it out. Second is to purchase broad market index funds that pay a dividend. And third is to purchase real estate investment trusts in the account, since REITs, real estate investment trusts, their dividends are non-qualified, taxed a little bit higher than my regular ordinary dividends, and so placing them in the Roth helps offset that disadvantage. So I'm going to show you how I'm working towards all three of these objectives. I have the spreadsheet I've been working on sharing here, and now I'm just at the midpoint of the year. We've got 28 weeks of contributions logged in here. So every Monday, $125 goes into the account, and this handles my first objective. $125 times 52 weeks equals $6,500, right? Now, I get for younger folks, this could seem like a lot of money. The younger you are, the longer this could work for you. Let me just say this. Seriously, if I could go back to my 20-year-old self, tell him one thing, it would be to start maxing out the Roth IRA immediately. That's it. Now, to my second objective, I'm buying an index fund and I'm purchasing it every single week to dollar cost average. The fund I've chosen for 2023 is SCHD. What I've been doing is buying one share of SCHD at the opening of the market on the first week of the trading day. The plan is to make this a significant portion of my Roth account by buying one share every week via dollar cost averaging. And so far for 2023, it's been a good year to buy this one. Year-to-date shares of SCHD are down 2.73%, as 2023 has been the year for AI and tech stocks, while SCHD heavier on the financials, the industrials, healthcare, and consumer defensive. Those are the top four industries held in that fund. Why SCHD, you ask? As if you don't know. Well, from a dividend investor's perspective, this has been an ideal ETF fund since its inception about a decade ago. SCHD gives you three things. It performs at a rate that rivals the broader market, your S&P 500, and in a bear market, it should outperform. And it pays a nice yield at the moment. That's a 3.6% yield. It has a fantastic track record of dividend growth as well. Now, over the last 5 years, the dividend growth rate on average has been about 14%. And it's hard enough to find individual stocks that do this consistently, But SCHD has been doing this, and accomplishing this by doing a reconstruction once a year and a balance once a quarter as it follows S&P Global's, ticker SPGI, Dow Jones US Dividend 100 Index. It handles all that work for us for an extremely reasonable 0.6% expense ratio. Quite reasonable. Basically means for every $10,000 invested in SCHD is costing you about $6 a year to take advantage of all that. And that's next to nothing. Something like this is perfect for dollar cost averaging. It's essentially a basket of 100 stocks. Although in truth, the top 10 do make up a large portion of a fund. So at the time of publishing, real quick, those top 10 are Broadcom, United Parcel Service UPS, Texas Instruments, Home Depot, PepsiCo, Cisco Systems, Amgen Inc., Coca-Cola, Chevron, and Verizon. And those funds make up 40% of the SCHD ETF. The other 90 stocks are the other 60, so it's quite heavy on these top 10. So back to my spreadsheet. I've documented each time I have purchased the SCHD ETF at the beginning of the week to track my average cost. I bought it every single week. That's dollar cost averaging. Right now, my own cost basis is $73.42. And oddly enough, SCHD is trading at practically the same value, $73.38. Notice I was buying it when it was $76, $77, and also when it was $70. This is dollar cost average. As of right now, these 28 shares of SCHD are projected to pay out $72.80 over the next 12 months. This is just about enough that it could purchase another share of itself in the next year just from its dividends. Pretty cool. And these shares of SCHD has already brought in a little bit of dividend income into this account, $23.78 between the first two payments, one in March, one in June. We'll have 52 shares of SCHD at the end of 2023, and that's going to be producing about double what it is right now, say around $140 of dividend income annually, and growing, of course. I've had this asked before, and for the dividends you receive in your IRA, do these count towards your contribution limits? And the great thing is they do not. And that's not a dumb question. In fact, it was the first question I think I had to myself at that time, worrying that I could, might add too much. In fact, look, you can see that I'm down on my investments very slightly here, but the value from my $3,500 I've added into the account is actually $3,954.14 that I was able to invest, because I brought in about $465 between dividends and interest in the first half of 2023. So more than 10% of the value added into my Roth comes from prior year investments in the account. That's just 2 years of maxing it out before this. That's really all this is. I started investing in this account as a fresh start after my divorce, right? My other retirement accounts got chopped in half at the time, and I was actually going the traditional IRA route back then. The point is, keep at it, and eventually the dividends you receive in your account is going to exceed the amount you're allowed to contribute for that year. And that to me shows you the real power of dividend growth investing. So the longer you can let you reinvest these dividends, the better. So I buy SCHD here every week. I'm using on average about 73 of the 125 I've added, leaving me some more money to invest. And what I do is I take this additional leftover contributions, and I add it with the dividends I receive that month. I don't automatically drip them, okay? And in 2023, I'm adding to positions with this money in real estate investment trusts, hitting my third objective. Remember we talked about how REITs trigger a higher tax liability usually than qualified dividends? So the aim here is to maximize the benefits of the Roth. These REIT purchases in 2023 have added a near equal amount of forward income that my SCHD purchases have added, $72.77 in forward income to this account at about the halfway point of the year. Now let's quickly go over the 4 REITs I've been buying this year. These are high conviction for me, building these up into nice position. These are the 4 REITs. First, I started a new position in American Tower Corporation, ticker AMT, and I continued buying it on the way down. It's starting to come back up, but it's now at 2.67%. That's what I'm down. I purchased a share in January, a share in February, and a share in May. I definitely would like to add a couple more shares in the year 2023, ideally below this average cost. While it's not the highest yielding REIT at 3.24%, this is a yield that is 61% above its own 5-year average, presenting a really unique opportunity in what has been a very strong dividend growth stock. AMT has a 10-year dividend growth track record. That's as long as they've been paying the dividend. They announce often new raises every quarter. Their latest increase amounted up to 12% over the last year. AMT is one of the largest REITs on the market. They own over 226,000 communication sites and are a huge player in keeping our world connected. Second, I've been buying into CubeSmart, ticker CUBE. Been building a position in this one for exposure into the self-storage space, which is a nice, easy to understand business model. I see firsthand the growth trajectory this company has in my own local area, and I've beefed up my position by 7 shares so far in 2023, working to build this one up to 100 over the next couple years. I'm about a quarter of the way there. I'm buying this one above my cost basis right now, which is around $42, but it is high conviction. 13 years of dividend growth, latest dividend raise at 14% back in December of 2022, and I will definitely be adding more in the latter half of 2023. The third high conviction REIT I've been buying in this account is Vici Properties. This is probably the most popular in dividend investing circles, save for perhaps my last pick. Now, Vici owns a ton of luxury resorts and casinos. Many of the properties are located on the Las Vegas Strip. They serve as a landlord to casinos and hotels. In June, I added another 8 shares to my Vici position. It's another one that I started building about a year ago. I bought my first shares when Store Capital announced it was going public. I sold out, a little bit of profit there, and began building a position in Vici. Vici does lack the track record of the other companies, but they've only been in existence for a few years, so the dividend growth streak, 4 years, latest raise was at 8.3%, shares are yielding 5%, right in line with their 5-year average. Finally, the other REIT I've been buying here is Realty Income, ticker O. The company dubs itself the monthly dividend company, living up to this name by paying out a growing monthly dividend over the last 28 years, making them a dividend aristocrat. Now, I increased my position in O by 7 shares so far in 2023 at an average cost of $60.26. Now, my full position is down even more, so it's likely I'm going to be adding this position in July while it's still below that $60 mark. Shares of O are yielding 5.15%, which is 18% above the 5-year average, making this an enticing looking chance to add some shares. Realty Income has over 12,400 properties between the US, Western Europe. They boast a 99% occupancy rate on their portfolio. This is one I think just about every dividend investor is in or probably should be in. I would likely rate it as a top 5 buy and hold forever dividend stock. So these are the REITs I've been buying up in 2023 in my Roth. Now Vici in particular, I think I would like to begin accumulating heavier outside of the Roth. Better to buy in the Roth, but I won't let taxes be the final deciding factor if I have high conviction. So Vici is actually a candidate I'm considering to replace my Walgreens Boots Alliance position in another portfolio, the public portfolio I'm sharing on this channel. But yes, that's 6 months of my Roth IRA here in 2026. Right? So right now, I'm right on track to max this out. I'm in a dollar cost average to a nice position of 52 shares of SCHD this year, and I'm beefing up my real estate exposure without having to deal with landlord nonsense, which is always nice. I definitely recommend everyone who's able to take advantage of a Roth IRA do so, and I definitely appreciate you sticking around with us here. If you want an update on my June investments in my taxable dividend growth income portfolio that I've spent the last 9 months building up here on the channel, for weekly contributions, go ahead and click into this next video. We made some milestones in this public account that I am pleased to share. Have a wonderful day, and until next time, keep investing.